Personal Credit Basics, Lesson Number 1, Part 1 of 2. Hey there and welcome to the Zoom-a-Zip channel! If you are ready to clean up and repair your credit report and personal data, then this video is for you. Welcome to your first lesson. My name is Bruce and I'm here to teach you all the basics. When I'm done, you will literally have everything you need to start repairing credit. But first things first. In order to get there, I want to make sure everyone understands what credit actually is. So we're going to start with the easy stuff. Here on Lesson Number 1, we're going to start with a little history lesson on the credit system and why credit is just so important. I'll break down the elements of what a credit report really is, and we'll talk about how credit scores are calculated and how debt impacts your credit. At the end, I'll share some tips on how to optimize your scores, and then afterwards we'll get into a more in-depth lesson on repairing credit. Fair enough? Alright, this is going to be awesome, let's do it. So what exactly is credit? The real definition of credit is the confidence in a purchaser's ability and intention to pay and entrusting the buyer with goods or services without immediate payment. In order to track all this data, companies use credit reporting systems and credit reporting agencies use these systems and reports to decide whether or not to give credit or a loan, or how much interest they're going to charge you for it. Your credit report is based on the bills you paid, missed, or been late paying, the loans that you've paid off, plus your current debt amount. Your credit report contains information on where you work and live, how you pay your bills, and whether you've been sued or whether or not you filed for bankruptcy. Credit reporting agencies, also called credit bureaus, gather this information and they sell it to creditors, employers, insurers, and they even sell it back to you, the consumer, in the form of credit reports and credit scores. Credit reporting began more than 100 years ago. There's some basic dispute on who started it and where, but the approach was basically the same in the late 1800s and early 1900s. Several individuals in different cities began going from merchant to merchant taking notes about the people with whom they had credit arrangements. With those notes, and they could say anything, from he's a reliable customer and always repays his debt, to he won't pay but his father's gonna cover what he owes. When a consumer would ask for credit from a merchant, the merchant would call the local credit reporter, who would share the information they had on file about that person. So over time, credit reporting became purely objective and came to include only account payment history. It also grew from a local business to a major national industry in the late 1960s. Credit reporting became computerized, which made it possible to become truly national in scope. In 1970, the Fair Credit Reporting Act, also known as the FCRA, became the very first law to govern consumer reporting, including credit reports. The FCRA has been amended several times but remains the primary national law governing credit reporting. It specifies who can get a copy of your credit report and under what circumstances, and most importantly, what the credit report can actually include. It also defines the responsibilities of credit reporting companies and the responsibilities of businesses that choose to report information to the credit reporting companies. Most states also have laws that regulate credit reporting. The laws recognize that lenders need credit references to protect their businesses from losses and provide better services to their customers. By sharing credit payment information, lenders are able to make better decisions and make credit more available to more people at a lower cost. And like no other reference service, consumers have full access to the information that's shared. So why is your credit so important? Your credit is like your reputation. Once you mess it up, it takes some time to rebuild it. Your credit impacts virtually every aspect of your life. At least most people don't have cash to purchase everything. It's just the way it is. Your credit score is a direct reflection of what risk you are and how much you'll pay in interest. If you want a home or a car, credit is the first thing the bank will ask about. If you're looking for a personal loan or a business loan, same thing. What's your credit score? Homeowners insurance, car insurance, even life insurance companies are now pulling your credit. Employers look at your credit, especially for jobs with any type of financial responsibility, will want to see that you are financially responsible, and your credit is the best way for them to determine that. Nearly every opportunity in life is affected by your credit. So in short, your credit is extremely critical and impacts everything. Here's some really interesting statistics regarding credit reporting. Approximately 79% of all credit reports contain serious errors or mistakes. Over 61 million Americans have subprime credit scores below 650. Nearly 33 million Americans do not have enough credit to even generate a credit score. And 24 million Americans have no credit file at all. And last but not least, most consumers in the US have no idea whatsoever how to get a copy of their own credit report. That's pretty crazy when you think about how much your credit impacts your life. Let's talk about the three big bureaus. I'm going to start with the basics. There are 3 major credit bureaus and nearly 1,000 smaller bureaus. Make no mistake, credit reporting is a big business. TransUnion is based in Chicago and provides service to approximately 45,000 businesses and approximately 500 million consumers worldwide. It's also the 3rd largest credit agency in the U.S. Equifax, on the other hand, was founded in 1899 and it's the oldest of the 3 agencies. They gather and maintain information on over 400 million credit holders worldwide. They're based in Atlanta, Georgia. Equifax is a global service provider with over 7,000 employees in 14 countries. Finally, Experian. Experian is the largest of the 3. They are based in Ireland and they employ over 17,000 employees. Their revenue last year was over $5 billion. Towards the end of this course, I'll explain some facts about these 3 credit agencies that will literally shock you. Even though there are many different bureaus, all credit reports have the same basic structure and anatomy. You'll find your personal information. This includes your name, potential aliases, your date of birth, your social current address, your previous addresses where you've lived, and employment information. You'll find negative accounts. Negative accounts are anything that wasn't paid or paid late. These are items that you do not want on your report because they lower your score. Also, items that you do want on your credit report are positive accounts. Positive accounts are essentially any accounts that have been paid on time. They help your score. You also may find public records on your credit report. Public records are typically court documents such as judgments, liens, bankruptcies, child support, and even sometimes criminal histories will show up in the public records section of your credit report. Another thing you'll find are inquiries. Inquire areas are a record of any time your credit report has been requested or pulled. There are several different types of inquiries, and each have different meanings. I'll be explaining this in greater detail in a few minutes. You can also find a consumer statement section on your credit report. Consumer statements to me are ludicrous. I say that because essentially it's an area on your credit report that allows you to place 100 words or less, an explanation about something on your credit. From my experience, adding a consumer statement never helps. If anything, it can make you look guilty for something a lender wouldn't have even wondered about until you mention it. The last thing that you'll find on your report is furnisher contact information. Furnisher contact information includes the names, addresses, and phone numbers of all of the companies that have reported information about you to the credit bureaus. This information is kept available to you, the consumer, so you're able to contact anyone that reported any information about you. Let's talk about the negative items and red flags. First, high balances. One of the most important aspects of your credit score is the level of credit card debt measured by credit utilization. Having high credit card balances relative to your limit increases your credit utilization and it decreases your score. The more debt you have, the more of a risk you are. Next, late payments. Did you know that 35% of your credit score is payment history? Being late on payments will hurt your credit score. Consumers often send a payment on time, and late payments show up on the credit report because of clerical errors, mail delays, or simply due to sheer incompetence. These late payments can cause severe damage to credit reports and cost consumers thousands of dollars in unnecessary interest. Let's talk about charge-offs. Sometimes you may see the term charge-off or CO on your credit report. This can be confusing to many people because it almost sounds like it's a debt that isn't owed, but that's not the case at all. As an example, if you're late paying a credit card after a few months, typically 3 or 4 months, the creditor begins to lose hope that you'll ever pay the account. The reason is, statistically speaking, you won't. The longer you go without paying, the more likely it is that the account will never get paid. Now try to wrap your head around this. Creditors and lenders pay taxes on your debt. That's right. Your debt is considered an asset in a government's eyes, and the lender will continue to pay these taxes until the debt is either paid or charged off. So, after about 90 to 120 days, creditors will typically report the debt as uncollectible to the credit bureaus and the government, which will allow the creditor to stop paying taxes on the debt as an asset for the company. This does not mean you no longer owe the debt. It just means that the creditor believes that the debt is uncollectible. At this point, the creditor will typically either sell the debt to a third-party debt collection agency, or in some cases lease it to a company that will try to collect it. Meanwhile, the account is on your credit as a negative item called a charge-off. Next, repossessions. If you're ever late paying a car or a boat or an RV or any of those type of vehicles, it can get ugly. The creditor or lender will usually seize the vehicle, take it in the middle of the night, or show up at your front door and take the vehicle. Then they'll sell it at auction for a fraction of what is owed. Then they sell the balance to a collection agency, and you're left owing the deficiency balance. Next, bankruptcy. Bankruptcy will typically devastate your credit reports. Bankruptcy, or insolvency, is a legal status of a person or an organization that cannot repay the debts that are owed to the creditors. Creditors may file a bankruptcy petition against the business, or a corporate debtor, which is called involuntary bankruptcy, in an effort to recoup a portion of what's owed or initiate a restructuring. In the majority of cases, however, bankruptcy is initiated by the debtor, a voluntary bankruptcy, that is filed by the insolvent individual or organization. An involuntary bankruptcy may not be filed against an individual consumer debtor who is not engaged in business. Judgments and liens. So when a judge or a government orders you to pay a debt or places a lion on you, this is not a good sign to lender. You definitely do not want judgments or liens on your credit report. Next, inquiries. When consumers apply for credit, they authorize those lenders to ask or inquire for a copy of your credit report from the credit bureau. An inquiry appears on your credit report. Inquiries are often placed on credit reports by businesses that the consumer did not apply with. Multiple hard inquiries negatively affect your credit score. Not only will your credit score suffer a few points of damage for each inquiry, you may appear credit desperate and risky to lenders. The only inquiries that count towards a consumer's credit score are the ones that result from applications for new credit. Most inquiries only impact your credit scores for a year, some of them up to 2 years. Next, a foreclosure. This is when you stop paying on a mortgage. Foreclosures have recently skyrocketed after the collapse of the subprime mortgage industry. Foreclosures are extremely negative and usually high dollar amounts considering it's real estate. Next, duplicates. Duplicate entries are instances where a particular situation shows up more than one time on a consumer's credit report. It can make it look as if they have more than one debt or credit issues than they really do. This can negatively affect the chances of getting a loan or having credit extended. Some of the most common duplicate, triplicate, or even quadruplicate entries are medical bills, student loans, utility bills that have been sold to multiple collection agencies, and any other item that gets sold in a resold may show up as a duplicate or worse. Other factors that impact credit scores negatively, 1, is debt. The more debt you have, the higher of a risk you are to lenders, and the lower your score goes. Simple as that. Next, let's talk about not paying at all. When you're late on a bill, it's not good, but when you completely ignore your bills, that's much worse than paying late. Each month you miss a credit card, auto loan, installment account, or a mortgage payment. You're 1 month closer to having the account charged off. As we discussed a few minutes ago, eventually the creditor will consider the debt uncollectible and either sell it or lease it off to a third-party debt collector. We have seen thousands of instances where the original creditor continues to report the entire balance. Then an additional collection item appears in the collection section of the credit report. This causes duplicates, triplicates, quadruplicates, and excessive and incorrect balance amounts. Last but not least, when you have accounts sent to a collection agency. Creditors often use third-party debt collectors to try to collect payments from you. Creditors might send your account to collections before or after charging it off. A collection status shows that the creditor gave up trying to collect a payment from you and hired someone else to do it. It's very negative, and you definitely do not want that on your credit report. Now that you know what can hurt your credit, let's discuss what will actually help it. These positive items will increase your scores. To start, low balances are obviously better than high balances. Keep this important piece of information in mind throughout your life. Every dollar of debt you owe is considered a risk factor. The more debt you owe, the more likely it is that you will not repay it, and every dollar of debt will hurt your credit. This is a catch-22 for most people because you need to borrow money to build credit. But borrowing money hurts your credit at the same time. There's an old saying that goes, banks are only interested in borrowing money to people that don't need it. And boy, is that true. Next, on-time payments are always going to be good. Doesn't matter if it's a credit card, a home loan, auto loan, student loan, or whatever. Pay it on time, and it's a positive factor that will only help build your credit. Next, aged accounts. The older your open accounts are with positive credit history, the more likely it is that you'll continue to pay on time, and therefore, old open accounts are positive and will improve your credit score. Next, of course, you always want accurate information. Not only accurate information, but just as important, your personal information must also be correct. There are a few reasons for this. Your name, for example. If you have multiple aliases or misspelled first, middle, or last names, lenders may consider you a higher risk because it may be a sign that you are not who you say you are and possibly be an identity thief. How about your employment information? If you're applying for credit, insurance, or a job, and your employment information is incorrect or inaccurate, or it's different from what's on your application, that's a big red flag. There are many other instances such as your address, your social security number, your date of birth. You need to make sure they're 100% correct and accurate. Finally, let's talk about diversifying your credit. Lenders like to see that you're able to handle paying different types of accounts. This means mixing it up. Having a mix of credit means that you have different types of accounts reporting to the credit bureaus. With that being said, for example, if you only have installment loans, that can hinder your ability to get a home loan because your credit is not diversified. You'd be much better off showing that you have experience paying installment and revolving accounts as well. So we will pause for a short break and continue shortly. Remember, if you need more guidance or if you just want the experts at zoomazip.com to do all the work for you, just email expert@zoomazip.com. If you have any questions, drop them in the comments below. Thanks for watching. Don't forget to like, subscribe, and hit that bell icon for more tips on managing your credit and personal data. Visit zoomazip.com for more info and take the first step towards a better credit future.